Hey everyone, Paul Walden with Create Tailwind here. I just wanted to take some time today, talk a little bit about what exactly the infinite banking concept is, and later on show you an actual sample policy of this business owner who becomes his own banker, and that's taken from this book here, Becoming Your Own Banker, written by Nelson Nash. And if you haven't done so already, it's a great book, and I recommend reading it. But let's go ahead and jump right into it. Banking, creating a legacy of guaranteed tax-free wealth. Now, before I teach you how to become your own banker, we need to look at first how banks are able to make money. So let's say you deposit 100K into your banking system, and the bank is going to go ahead and give you 0.5% on that 100K, which we all know now isn't even 0.5%. It's more about maybe 0.25, even lower than that. But they're going to turn around, take your 100K, and give it out for a house loan at 5.5%. Now let's say the buyer gives it to the seller, and then the seller goes ahead and puts that money back into the banking system, and then the bank's going to turn around again and loan that money back out for a car loan. Let's say it's 6%. So you're going to buy a car, and the dealership's going to put that money back into the bank, and then again the bank is going to loan that money out for a house remodel, let's say for 7%. And this keeps going in a cycle. They put the money back in the banking system, and let's say one more time, debt consolidation, they loan it back out. But essentially, this is how banks make money, all off of your 100K here. So they essentially loan out that 100K and make all this interest off of your money. So let's look at how they did. So let's take 0.5% from 5%. So the bank earned 5% on this house loan. They earned 6% on the car loan. They earned 7% on the house remodel, 10% on debt consolidation. So overall, they earned 20%, all off of your 100K. And look what you earned, essentially 0.5%. Now, how much better did the banking system do than you? 0.5 goes into 28, 56 times. So they did 5,600% better than you. So here's a little simpler picture to look at how banks make money also. So you deposit $10,000 into the bank. They loan that out for a loan at, let's say, 10%. So the bank earns $1,000 and you earn $100 at your 1% that they're going to give you, all with your money. Now, the whole idea of becoming your own banker is, in the policy, we want to be the depositor, we want to be the bank, and we want to be the borrower. So we're earning interest all along the way, which is the whole idea of becoming your own banker. So how are we able to become our own banker? And I'll tell you right now, it's through a dividend-paying whole life insurance policy. Now I have this slide up because I wanted to show you guys why we run our money through life insurance policies instead of anything else, maybe instead of our bank account, let's say. It's because life insurance is the only one in the market that has these 5 characteristics. It has a competitive rate of return, which is 4.5% plus dividends, which right now is around 6% that you're earning on your money. You're earning that 4.5% guaranteed. It's all guaranteed. You're earning it tax-free, and you can also access it tax-free. It's liquid, meaning you're able to access it at any point in time they want, so it's just as liquid as your, I like to say, savings account, and it's just as safe. And it's creditor proof, meaning that if you do go into debt and you have a lot of debt owed and something happens to you, those debtors aren't able to access the money within the life insurance policy. Now, it's important to think about running your money through the life insurance policy rather than just having it sit there and compounding just like an investment. So we think of it more as a financial vehicle to run your money through, and I like to call it an and benefit, meaning you get all these benefits of the life insurance policy of having your money just sit there, and you're able to access it all tax-free, and you can invest it anywhere else you want. Let's say you have it in life insurance and you want to invest it in real estate. You're able to do that. So you're getting the benefits of life insurance and you're getting the benefits of real estate, if that makes sense. Now, the way we fund it in the life insurance policy is over about 4 years. So here is a $50,000 premium example. In the first year, we're going to put in $50,000, which is what these two columns are showing here. 30,000 of that, which 60%, so 30,000 of the 50,000 is going to go straight to your cash value, and that's called a paid up addition. Now 20,000, I don't know, for those of you who don't know much about life insurance, is going to pay for the premium, and that is what the death benefit, the death benefit is what the premium pays for. So the first year you put in 50,000, we're going to be able to access 35,000 since this first year. The 20,000 you put paying towards the premium, it's going to pay for the death benefit, it's going to pay for expenses in the company and what have you. Second year you're going to put in 50,000, you're already going to be able to access almost that whole 50,000. Now the third year you put in 50,000, and depending on how old you are, your health standards and whatnot, which is affected on life insurance, most of the time you're going to be able to access that entire 50,000. And the fourth year you are for sure. And then now, as you can see, this fifth year, so we loaded it 4 years with cash value just to have it become efficient and run on its own. And by run on its own, this is what I'm talking about. So the fifth year, we're just going to start paying this premium because we put in 20,000, and we're going to have $25,000 to take out and do whatever we want with it. By the 10th year, we're going to put in 20,000, and we're going to have at least 35,000, if not more, to be able to take out. And that's the policy running on its own and becoming efficient. But this is the reason why life insurance makes it more efficient, because it starts running on its own, and let's say by the 10th year you're almost going to double your money of what you're able to access. Let's say by the 15th year it's going to be even more than that. And checking savings and checking accounts, bank accounts, they just don't compare to this at all. And this is the main reason why we like to fund it through life insurance. So this is what the big picture looks like of becoming your own banker through a policy. So you capitalize the policy, you take out loans, so you're paying yourself that interest and principal instead of the banking institutions. Just like that first slide I was showing you guys, how the banks loan out the money and collect that interest and keep their money in motion. Essentially the same idea, but now you're using it from your own bank. So take out loans from yourself, pay yourself that principal and interest, and in return the interest you're paying yourself, then start to earn more interest in the policy, that 4.5% plus dividends. And so you're earning interest on top of interest, and guess what? All that's tax-free, and you're able to access it tax-free and building a legacy of wealth, and we can retire on it tax-free. So this is kind of a system that encompasses pretty much everything in your entire life, but it's important because as your money sits here, you're earning interest. Again, that 4.5% plus dividends. When you use your money, you're earning interest. And this is kind of difficult to understand, but let's say I take out $10,000 from my policy and I pay principal and interest to myself, but essentially I'm taking out a loan from the insurance company. My $10,000 is still sitting in my policy, growing uninterrupted. So the interest I'm earning on my $10,000 in the policy is growing at a greater rate than the 5% I'm paying back to the insurance company. So in return, I'm actually earning more than what I'm paying. So I'm still earning money as I use it, which is how I like to explain it. And then you're an interest that you pay yourself or someone else pays yourself if you were to give out a loan to maybe your business or anyone else. So now let's take a look at that example I was telling you I was going to show you from the book Becoming Your Own Banker by Nelson Nash. And this is just taken straight out of the book. So this guy owns his own business. It's a tree sharing business. And so he puts in $40,000 for the first 4 years to fund his policy for his own bank. And then he just lets it sit there. So this is looking at it as an investment. So he lets it sit there for about 36 years. And at the end, he has $1.5 million to retire on and use for his retirement. So this is looking at the difference between keeping this money in your bank. So he put in life insurance. So after 4 years, he has that $160,000 essentially to use. And this cumulative net outlay here is what he would have if you were to have it in your banking account. So instead of having to earn all this interest through the life insurance policy, he would only have $160,000 instead of this $1.5 million to retire on. And hey, guess what? This is his death benefit that he's going to pass on when he does pass away, and that's all tax-free to his beneficiaries. So not only is he able to retire on all this, tax-free. He also passes on the death benefit tax-free. So, like I was saying, he owns his own tree sharing business, and this is what he pays to the banking institutions to fund his business. So he leases out 4 trucks, 2 tractors, 1 tree shear, and he pays $16,000 a month to the banks. But since he has his own banking system now, he's going to take out a loan from himself, and we're going to start with 1 truck. This is actually a lease agreement he wrote up for himself, but he's going to take out a lease for 1 truck, a loan for 1 truck, pay himself $1,500 per month back, which is what he's paying to the bank. So he's paying himself back that $1,500 a month, and he has to replace that truck every 4 years since the wear and tear on it, but pays himself that interest instead to himself, pays the interest to himself instead of the banking institution, and by doing that, just by doing that every 4 years, he then has almost $500,000 more to retire on. So he takes that out when he's ready to retire, and he has all that tax-free. Now this is what it would have looked like if he did the banking. Let me go back to this slide. If he did banking in his bank account, and I just like to compare this because a lot of people are so worried about keeping their cash in their account, where when they have it in this policy, it's just as liquid and just as safe. And now it's just earning all this interest, and they're using it as a financial vehicle with all these benefits. But put in $160,000, and he funded his 1 truck every 4 years, and this is what it would look like at the end when he did retire. And he would have $315,000 to retire on instead of $2 million. Now, these numbers, I mean, straight out of the book, these numbers are a little inflated, but you still get the idea of the benefit of running your money through life insurance instead of just doing this banking concept through your bank. Now let's say, since he has more money to spend here, instead of just taking out a loan for 1 truck, he's going to try to cap out what he has in here, pay himself the interest instead of the banks. So he takes out a loan for $160,000, about $157,000 for the 4 truck loans and 1 tractor, and pays himself that. He has to replace them every 4 years, just wear and tear. So he pays himself that interest instead of the banks. And just by doing that, being his own banker, he has $2 million more to retire on than what he did. And this is called keeping your money in motion. And that's what I was showing you in that first slide, how the bank kept loaning out the money for all those different loans. And that's what he's doing here. He's just paying himself that interest, building all this tax-free, and now he has all this to retire on tax-free, so he's able to take out more every year. And then, look, when he does pass away, he has this death benefit to pass on tax-free. So you really can't beat it. And this is what, let's say you did the banking concept through his bank, this is what it would look like if you didn't run it through the life insurance. He would have $946,000 to retire on instead of this $3.5 million. But that's the whole idea of banking, and that's why we run it through life insurance, just because it's more efficient and all the benefits you get from it. So this is Paul Walden with Create Tailwind, and I look forward to seeing you guys next time.